Welcome back. You're watching The Money Show, and now let's talk about a very crucial question that many Indian investors are grappling with. Should investors continue to opt for fixed deposits in a time when banks are reducing fixed deposit rates and the equity markets are showing increasing volatility? On one hand, we have a traditionally safe investment option in fixed deposit, which offers guaranteed returns and a sense of security, definitely. However, looking at the rate cut scenario, lowering of fixed deposit interest rates, one definitely needs to evaluate the return angle over here. And on the other hand, equity markets, though potentially offering higher returns, are currently experiencing significant fluctuations, adding a layer of uncertainty. Now, with these two contrasting dynamics at play, where should investors look for stability and growth? Should one stay with the safety of fixed deposits despite the declining rates, or is it time to consider alternative avenues, including equities or other asset classes? So in today's discussion, we will weigh the pros and cons of fixed deposit, the current economic environment, evaluating the risk and rewards for you. And to help you understand all of this, I have with me Suresh Nandagopan, founder, Ladder 7 Financial Advisory. Suresh, good evening and welcome to the show. A very crucial question now. On every fixed deposit investor's mind is whether you should be locking in money in fixed deposit, because traditionally who like fixed deposit definitely would think about this, but also people who are experiencing volatility in their investments as far as equity market are concerned would also having this question in their mind. What is your take on this?
Yeah, so there are two kinds of investors. One, an investor who is slightly risk averse or wants to take lower risk. And traditionally, they have been
Yeah.
looking at fixed deposit. For those people, we are aware about a rate cut which has happened some time back. And going forward, also, there can be a rate cut from RBI, which will most probably be passed on by most of the banks in terms of lower interest rates in terms of the deposits. So if people are looking at fixed deposit in a very serious way as far as their investments are concerned, considering the environment that we are in today, I think probably this is probably a very good time for them to zero in on whatever tenure and whichever bank they want. This is the time to fix the rate for themselves. So you get something like 6.5 to 8% kind of return, depending on the bank, depending on the tenure. So for those people. And as far as the equity markets are concerned, you rightly observed there is a lot of turbulence at this point in time, a lot of volatility at this point in time. We don't know when it will kind of settle down. So people who want to move to safety, apart from fixed deposits, from the banks, you also have corporate deposits. You have other things also, like debt mutual funds are also there, which is 100% in debt again, instead of a single party deposit, like in the case of, let us say, a bank, XYZ bank, you are putting a deposit into the bank, so it's a single party exposure. In the case of a debt mutual fund, there are multiple papers, maybe 15, 20 papers, so it's a multi-party exposure. There is a lot of diversification. The interest, or rather the return that you're going to get is not really fixed, but it's a very, very credible instrument which one can consider. So that is also another option. RBI floating rate bond is also another instrument one can consider. Currently, it is giving 8.05. And in my opinion, with very little risk, 8.05% return is very good. I mean, you have to understand that it can go down also, up also, because it's a floating rate fund. But at the same time, these two, three things can certainly be considered. Corporate deposit, I talked to you about 0.5 to 1% excess return one can expect for high credit quality corporate deposits vis-a-vis the banks. So there are 3-4 options which one can consider apart from the equities. So evaluate carefully and go for it.
Suresh, I really want to understand now. We are in a rate cut scenario now. We have a monetary policy coming up now, and over there a 25 PPS cut is also expected. I want to understand how soon the banks will start cutting deposit rate, because in a few bank scenario we're already seeing it. HDFC, few schemes of SBI, no new deposits are taken over there. Bandhan and Yes Bank also. That's for specific tenure, but then all across or across the board, how soon can we see these banks cutting down deposit rates?
It's all a factor of how much money they want. If they are flush with funds and they don't really want to keep the deposit rates at the current level, immediately the transmission will be virtually immediate. But if they really have a very robust offtake of loans, they may want to keep it at the current rates, or they may cut much less than other banks. It all depends on their loan book and how much money they have, how much interest they have from the various borrowers. So it's a factor of that, but largely one can say that banks which are having fair amount of CASA, which is most of the banks have worked on their CASA deposits. If you look at it from that point of view, many of them are near 35 to 40%. So the transmission is going to be fairly immediate, and that is precisely why I said if people are interested in locking in the rates, probably the time is now.
Suresh, so definitely we cannot compare the return that you get from fixed deposit to what you get from equity, okay? But then this is also a year where you need to really, focus on your asset allocation. Now is the time if you want to lock in money in fixed deposit for a specific period, you can. Otherwise, you have also given other options like debt mutual funds or RBI floating rate bonds. How many investment options in fixed income can you really consider? Because if there's something called as stability you want to give to your portfolio, security you want to give to your portfolio, you really want to reshuffle your exposure in equity and put little money in fixed income, what should be considered and why?
Yeah, we can look at the fixed income option. There are multiple fixed income options, but 1 minute I will dwell on the asset allocation. Just because there is volatility, we really cannot move from equity to debt. That will mean that we are completely doing away with the asset allocation that is suitable for a person based on the goals, and directly taking a market call and moving from equity to debt. So that is not what we want to advocate to anybody. However, if you are looking at safe options or a debt oriented or fixed income option, there are multiple options apart from bank FDs. You also have, suppose somebody is a senior citizen, then senior citizen savings scheme is there. There are people who have very low risk appetite. For them, small saving schemes, they are definitely there. Public provident fund for people who do not really look at liquidity in a major way, and they do not want an income. Those things are there. And apart from that, then other options are there. Like I said, corporate deposits and RBI floating rate bonds. All these things are there. There are multiple options available. And if you really want to set up an income, I would suggest that debt mutual funds are a very, very credible way of setting up an income through the systematic withdrawal. And for those people who are in the upper income brackets, for them the tax incidence will be minimal, and it's a very, very good option for setting up an income. Cumulative fixed deposits also can be opted, or any of the cumulative instruments can be opted for by people who are not really looking at regular income. And that for that one reason, debt mutual funds also scores wonderfully well. Because in the case of FD or bonds, whether you like it or not, whether you require the money or not, you are going to get the interest at a certain frequency. And that is going to be taxable in your hand, which will not happen in the case of a debt mutual fund. Till the time you remove the money, you are not going to be taxed, which is a very positive, and it's going to compound thing. So a lot of options available to you. I mean, you will have to choose carefully, and based on the asset allocation and your risk profile, you will have to choose wisely.
All right. I also want to understand the sweep in FD, and staggered method of parking money in fixed deposit. How can one utilize this particular strategy?
When FD is concerned, a lot of us maintain a fair amount of liquidity in our bank account for the expenses and for unforeseen contingencies and expenses. Typically, 3 months to 6 months of liquidity, and more than that in terms of contingency we do keep. But that's a very poor way of managing money, because your money in the savings account is going to yield maybe 3.5 to 4%. As opposed to that, in the case of a sweep in FD, above a particular threshold, which may be 10,000, 25,000, depending on the bank, beyond that threshold, whatever money you are having in your savings account will be swept into a deposit, fixed deposit, and it will yield the same return as a short-term deposit of a particular tenure. So you have the benefit of both worlds. I mean, you are having the cake and eating it too, in a sense. You are also getting a good return on your money. And at any point in time, if you really want your money back, in terms of, maybe you have put in a check or you have done a transaction online. So the money will directly come into your account, and at no point in time you will have a problem of no money. If you have sweep in FD, that will directly come into the account. So it's a very, very wonderful way of managing money. In fact, all the banks, most of the banks have this option. Investors should definitely explore this particular option. And as far as the staggered way of investing in FDs are concerned, that could be a good way, especially considering the fact that the interest rates are going to go down. Normally, what happens with most of the FDs is the longer the tenure, you have higher interest. But if you really see the FDs which are available now, I mean, after 3 to 4 years, it again starts coming down. So, depending on your goal, depending on the expenses that are coming up in the future, accordingly, you can actually invest in multiple FDs of multiple tenures to optimize your investment and optimize the return on your investment and to align with your various goals. There is also another very important reason why you should probably have this staggered approach. That is, I mean, if you have a requirement for, say, a certain amount, let us say 15,000, 20,000, something like that. If you have invested in a 1 lakh FD, you will have to, there is no other option but to cash out the entire FD and utilize your 10 or 20,000. Whereas if you have multiple FDs, you don't have to completely take out all the FDs. You just have to cash out from one of the FDs and use it for whatever goal or whatever expense that is upon us. So staggered FD is a good option. Again, use it properly. I mean, look at your goals. Look at which bank will be efficient from your point of view, and going for staggered FD if that is suitable.
All right. So, in-depth discussion on fixed deposit and how can you allocate your money in fixed income as well. I think with that, it's time to wrap up this particular discussion also. Thank you so much, Suresh, for being on the show and helping our viewers with their fixed deposit and fixed income strategy today. I think it's very important for one to consider looking at the kind of volatility, and especially, in order to secure all the gains that you might have had in last 2 to 3 years, asset allocation, diversification is the key to go ahead in your financial portfolio. All right, time to wrap up, and I'm going to leave our viewers with our WhatsApp number and email ID. Just in case you have any particular question related to any financial goal and you're confused about what kind of investment strategy is right for you, you can WhatsApp us your queries on 865-797-4571. We also have an email ID, which is themoneyshow@etnow.tv. So send across your questions. We will do your life financial planning on the show. Thank you so much for watching. Goodbye.